Welcome to TRAilblazing, capitalizing on tax receivable agreements, a Parallaxes Capital podcast that is here to guide you through the world of tax receivable agreements. It's time for TRAilblazing.
Welcome to another episode of TRAilblazing. In today's episode, we'll discuss the barriers to entry in the space and shed a little light on the secrets behind Parallaxes' competitive advantage and how we're carving out a unique position in the market. Today, you'll have myself, Saish Setty, GC of Parallaxes, along with Andy Lee, our CIO, for what I'm sure will be a great conversation. Now, the motivating factor behind this podcast is the fact that a common question we get from stakeholders is, well, what sets Parallaxes apart? Why haven't there been more dedicated competitors coming into the space? There are probably 5 major reasons as to why substantial competition has not yet encroached on the space, at least not just yet. And I'll let Andy kick it off with the first one.
Absolutely. So number 1, that's around domain expertise. I don't think you see many of the best and the brightest coming out of school saying, I want to be a master of the universe and I want to do it in tax. Many deal professionals hear the word tax and literally run away. Unfortunately, from the tax world, many are incredibly familiar with tax code, but often struggle to translate it into English. I would say many deal professionals view their annual tax filing obligations in April to be worse than going to the dentist.
I guess kind of offensive to all of our friends that are dentists, and hopefully not too many of them listening into this. But that does tie us in a bit to the next point, which is the duration of the underlying opportunity. Now, if you said that TRAs were a 1-year piece of paper, sure, then there's likely a host of firms that would field a competitor. But these are long duration assets. Many private credit vehicles, for example, that would target this opportunity if they could, have 5 to 7 year lives associated with them. And for a little bit of context, Parallaxes' first fund was actually a 21-year vehicle.
Just as an aside, when I know I look really young as an Asian American, but we definitely got the question if I was even 21 when we went out to raise our first fund. So
that's great. I'm glad we actually do the video version of the podcast to highlight that point too. But just to close off this point, I mean, TRAs, these are long duration assets, and it could be challenging for a lot of parties to even hold these assets. And maybe, Andy, do you want to touch on return expectations, the third point?
Absolutely. If you said this was an asset class that knocked out 40, 50% returns, we would expect significant competition in the space. People would solve the duration issue. They would learn and educate themselves around the domain expertise required to play in the space. Unfortunately, the returns in the space are significantly more muted given the long duration nature of the cash flows. These cash flows are being compounded for a very long duration and at such a high clip. If you were compounding at 40 or 50%, you would be delivering the seller cents on the dollar, let's call it sub 10 cents. And at which point of time is there really a transaction to be done?
Yeah, definitely. And then to move into the fourth point, it's really the go-to-market motion here, which is driven by the lack of brokers. Now, go-to-market here is very challenging as this is not an intermediated space. Transactions often require one-on-one outreach. And from the broker's perspective, well, how do they actually get paid? They're typically getting a commission based on the sale price. So they either want high sale prices and ideally frequent sales, or at least one of those two. And when you think about how TRA transactions operate, we often like the parallel of a vitamin versus a painkiller. So, Andy, let's say you wake up with a splitting headache. You'll immediately grab for a bottle of Advil or something like that, but you probably know that taking fish oil or something like that is good for you, but you'll just never have the same urgency to do so. Like, nobody really wakes up and is in a mad dash to grab their Flintstones vitamins.
I don't know. Those are pretty damn delicious.
Like, I guess maybe we can exclude those like gummy vitamins from this part of the analogy, but I mean, TRA sales are similar to the vitamins here. These are nice to have for a lot of sellers, but there's often not a clear catalyst for a seller to transact. And this can result in infrequent or unpredictable sales, and that further compounds the challenges for the broker community. Now, this also ties into the next point, and that's the size of these transactions. They just might not make sense for a broker who's typically compensated with fees that are tied to the transaction value of a deal. Andy, do you want to maybe speak to the size of the opportunities?
Absolutely. The size of each individual transaction that we found historically across the 7 years that we've been in the space is about $4 million on average. So that's primarily driven by the fragmentation of the TRA holder base that we are engaging with, whereby your counterpart at holder in a TRA, Saish, might sell, but you might, for one idiosyncratic reason or another, hold on to the underlying asset, which makes this an incredibly challenging opportunity set to scale in earnest. So that was number 5. I would suggest a 6. We're going to lay out in the next part of the discussion our right to win as a firm, and that we are the 6th barrier to entry in this space.
Yeah, definitely. And at Parallaxes, we do like to say that no advantage lasts forever. With enough time and money, any advantage can be overcome. But despite that, the challenge that we've set forth for our stakeholders is to build a long and durable competitive advantage that'll stand the test of time. And maybe one of the first prongs on that front is our track record. Andy, do you want to speak to that a little?
Absolutely. So I'm going to hit this quickly. We have been able to achieve a 19% realized and substantially realized gross IRR, which translates into a 15% net IRR since inception through February of 2024. And what we mean here by realized investments are ones that are fully paid off. And by substantially realized, we're looking at investments that are north of a 0.5 times DPI. And we also include another investment that is a oilfield services business.
Definitely. And there was a Bloomberg piece earlier this year that sported the title of DPI is the new IRR. And we're proud to share that over our existence, Parallaxes is close to returning almost a 1 times MOIC on all the capital that we've ever deployed across our funds and co-investment vehicles. Of our flagship vehicles, 3 out of 4 of our existing funds have at this point returned the majority of their capital to their investors. And our 4th fund, which is actually a 2023 vintage, has already returned over 35% of its capital to investors as of the end of February. And moving into the second point, it's really coming back to our portfolio. Our portfolio is unique. It can't be easily replicated by new entrants. At this point, we've acquired stakes in over 20 companies since our inception. And with that, there's no significant industry concentration across our portfolio. All but 2 of our TRA issuers are publicly traded. And looking at this group as a whole, there's a weighted average EBITDA of about 1.2 billion and a weighted average enterprise value of 7.4 billion. Our portfolio has an attachment point of 25% of LTV and a 2.2 times total leverage level, or a 1.5 times net leverage level, and a median 4.8 times interest coverage ratio. And in each case, these figures for EBITDA, enterprise value, leverage, these are all weighted based on the undiscounted principal balance of each of those positions. Meanwhile, in terms of credit quality, 16% of our portfolio has no significant debt, and about 27% are BB rated. And in each case, these figures are based on our estimates of the net present value of the relevant TRAs. Now, taken together, our portfolio, we have established positions with embedded call optionality that allow us to increase our investment in various TRAs. As a result of some of these toehold or smaller positions, we're actually able to begin building a dialogue with the company itself and provide them perspective as to what best-in-class TRA administration, reporting, what any of those things might look like. In time, we develop a very trusted relationship with the company itself and are just better equipped to transact in the future. And maybe, Andy, the third point here, pre-underwriting the universe. You want to give our listeners a little bit of that?
Absolutely. We're looking to start on third base versus starting on the home plate, insofar that as we think about the various opportunities that we're pursuing across all 150 plus existing TRAs that are out there, we have, from a credit perspective, developed 40 to 60 page memos on every single name. And we've been endeavoring to do that from a credit, legal, and tax perspective. So, do you want to hit the legal portion?
Yeah, so on the legal side, we've prepared initial legal diligence memos for nearly all of what we view to be the investable universe of TRAs. And these memos, they summarize, highlight the key terms and conditions of the TRA, which ultimately does inform deal pricing and structuring. And as Andy alluded to, we're hard at work undertaking a similar exercise on the tax diligence front to refine our approach to estimating projected taxable income and the utilization of TRA collateral. And to Andy's point, pre-underwriting the universe enables us to deliver greater speed and certainty of execution for TRA sellers. And with a cooperative seller and a cooperative company, we can actually close on a transaction in as quickly as 2 weeks, given all of the pre-work that we've done and completed for many TRAs. And how about the fourth prong, Andy, like our team?
Absolutely. So we have a dedicated team with a singular focus of owning the opportunity set. We're incredibly proud of the small but mighty team that we've built, who come from a diverse array of backgrounds. We like to refer to a page from the immortal Bear Stearns memos from the Chairman book. Highly recommended reading for our listeners. But we seek to recruit for individuals with what they call PSDs, or poor, smart, and a desperate desire to be rich. We've built a dedicated go-to-market team and established coverage efforts to help mitigate the impact of the J curve to our LPs. Do you want to talk about some of that?
Yeah, and Andy, I think you lead by example here by having, I think on average, 32 or more external discussions on a weekly basis. And I think a lot of our LPs have actually commented on this similar fact that we have unique founder market fit. Andy, you're obsessed with this space. I think your 2 a.m. G-chat messages are a common occurrence. And I think a lot of our friends and investors have described your obsession with the space, and maybe to put it politely, as batshit crazy.
That's a new one. Look, I like to refer to a blog post that Sam Altman of OpenAI has shared. It's called What I Wish Someone Had Told Me. Number one around that list was optimism, obsession, self-belief, raw horsepower, and personal connections are how things get started. That was likely the case for the first 5 years of Parallaxes. Sam's second point was the one that hit me hard. That being cohesive teams, the right combination of calmness and urgency, and an unreasonable commitment are how things get finished. And to that end, we brought together a number of talented individuals like yourself alongside us for this journey. We're looking to supplement the team as we migrate from generalist to specialist, and roles that we're looking for include a kick-ass tax director, a bomb senior counsel, and business development ninjas, among others, to help supplement our efforts. So on number 5, around media footprint. Look, we've led the industry in redefining the TRA market by shedding what was previously a one-sided argument as to the efficacy of the product. We've educated the media that TRAs bring significant value to the ecosystem, and which has resulted in features and quotes in publications including the Wall Street Journal, Bloomberg, Institutional Investors, Forbes, and the Financial Times.
Yeah, and we continue to be a thought leader in this space, or at least try to be, with the publication of our annual white paper. There we work to educate the broader community on tax receivable agreements, where the market is going, frankly, where we'd like to see the market going. We also love to put out our TRA league tables, where we highlight the amazing law and accounting firms that are focused on TRAs. And as our listeners probably know, we also launched this podcast that's focused exclusively on TRAs.
Hit subscribe. We need more subscribers than just Elm Arms.
Yeah, seriously. And on the sixth point, this is just an advantage cost of capital. Unsurprisingly, we're extremely focused on our cost of capital. We previously had a financing facility with a large bank, which we've since paid off. And we've been able to create avenues that'll hopefully allow us to achieve an investment grade rating for our debt. And we expect to approach the public securitization markets. Recently, we've seen A-rated paper price at a bit over T plus 200 bips. And we'd probably expect our paper to price a bit wide of that, given the esoteric nature of our asset class.
Work harder, Saish. We need to grind that down.
I'm trying my best. But alongside that focus on cost of capital, Andy, I know you have some plans for our fee structure as well.
Absolutely. Look, we're trying to drive alignment with our investors in the way that we only want to get paid when they get paid. So today, we're actively seeking to mitigate the upfront fee drag from credit vehicles. So today we charge a 1.5 and 20 to our investors, and we're looking to migrate that to a 0 and 30. The first amount, the 1.5, refers to a management fee, which is an annual fee typically paid on commitments, whereas the 20% refers to a performance fee, which is generally charged only on profits generated by the company. So we would like to be more so compensated out of the performance fee. And in our instance, we will only get paid whenever our investors get paid.
And this might sound odd to a lot of our listeners, I'm sure, in the investment management business. There are a lot of folks that seek to maximize fee revenue. And this is probably especially true of publicly traded investment managers, since public market investors generally crave the predictability of those management fee revenue streams that tend to be a lot more predictable. And when you see this in practice, KKR, Carlyle, for example, believe they recently raised funds from retail investors that had a 2% management fee, but no carried interest whatsoever.
I remember meeting with the founder of a publicly traded private equity firm because he has a TRA. And when I shared that I was excited to finally get carry in the Legacy and Lone Star funds that I had participated in, he said, "You are so young. Like, it's all about the management fee. Carry is fool's gold." That deeply shaped my perception as to how private equity firms think about performance. We're actively, as a firm, Parallaxes, are swimming in a different direction, assuming what many are seeking out there. As a firm, Parallaxes is the plural of the word parallax, which is an astronomy term to look at an object at a different angle, arriving at a different vantage point. And for us, we look at problems from a different angle to arrive at a different solution set. Parallaxes was named to convey our mission as to what we're building. People hear the word tax and inherently think brain damage, and that the speaker probably doesn't speak English or speak it well. We're here to change that, taking a very different view that tax is innovative, forward-leaning, and most importantly, commercial. Many are focused on the here and now. Parallaxes is focused on being long-term. We're missionaries, not mercenaries, and our jobs are to be stewards of the industry.
Amazing. And thanks, Andy, and thanks to all of our listeners to tuning in to today's episode. And don't forget to hit that subscribe button. Please stay updated on future episodes. We're available on Apple, Spotify, and YouTube. And your support means the world to us, and we're having a great time building this podcast with you all.
Gotta make that YouTube royalty revenue.
Yeah, talk about diversifying fee streams. Great. Thanks, everybody.
Keep riding with us as we blaze the TRA trail by subscribing in your preferred podcast app. Learn more and get in touch at plxcap.com. That's plxcap.com. Information presented is for informational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any securities. Parallaxes Capital Management LLC's podcast and its associated links offer news, commentary, and generalized research, not personalized investment advice. Nothing on this podcast should be interpreted to state or imply that past performance is an indication of future performance. All investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to consult with a tax professional before implementing any investment strategy. Investment advisory services offered through Parallaxes Capital Management LLC are registered investment advisor with the U.S. Securities and Exchange Commission. Registration does not imply a certain level of skill or training. Past performance is not indicative of future results.